but seems like most everyone's here, so good to see. Oh, how's everyone's day before we get going? How's everyone doing? Anyone make any money today? Oh, don't be shy. I don't bite unless you want me to. It's a joke, by the way. It's a good joke, huh, Vince? It's a classic. It's my go-to.
Was down 600 and then made it all back after your plus.
Very nice. Love to hear it. Love to hear it. Got some new people in here. Ryan, nice to see ya. Fitness, Cora, welcome in, guys. Just a quick little update. So these sessions, we like to hold these once a week outside of market hours, just to kind of talk about, what's going down in the market, what upcoming data do we have, and they're member led. So anything you guys want to ask about, whether it's related to a play review that we've taken, or maybe it's maybe a play review, or looking for setups, or anything to do with the Fed. Anything you guys want to talk about, we'll talk about so long as it's market related. I will do my absolute best to give you a good answer on it. Okay? So, we've got enough people in here, we can get going. I'm sure we'll have some stragglers coming in the next little bit. But I can either call on people or you guys can just speak up and shout out what you want to talk about. I got my stream going, so make sure you're tuned in. Good. Looks like everyone's watching. How about you, Ryan? Welcome to the group, man. Hope you're enjoying it. You got anything you want to talk about or look at?
I was trying to a little bit confused on I think it's called like test and retest.
Sure. Just do you want to look at like an example, or do you kind of just want like an idea?
Yeah, I mean just some examples and on how it works, and I heard it's a pretty good strategy, but I'm just trying to get better at it.
I mean, retest is. I mean, it all kind of depends on kind of the time frame you're looking at, and of course how you're looking to play something. I mean, we can look at there was a chart I was looking at the other day that we can look at here. Let me get the time frame going. This is just the most previous example that I can think of. I was doing a one-on-one session with someone a couple hours ago, and this is the time frame we were looking at. So let me just plug in the dates real quick. We were looking at 12, 17, 2024, a 5 minute. Right. So this is the let me clean that up. We were going over risk to reward. So I got a lot of funky drawings here. Let me clean this up. But essentially, right, we've got a pretty clean range here, right? Just kind of going back and forth, got stuck in a balance here over about 5 or 6 days, and we were going over risk to reward, so that's why these gray zones are here and a lot of these funky lines. But there was an instance in here where there was a clean retest play. So basically, right, you've got an established low here, right, and these two white lines are just areas of focus, right, for this specific time frame. This is an area that we were focused on. Real quick, Mr. Bagholder, you got some background noise for me if you don't mind muting. Appreciate you, boss. So basically, you get this area, right? Let's call it 34, right? It's been tested a number of times, right? You get 3 tests. It's clearly a proven resistance on the short time frames, right? It's something that people are paying attention to, right? So we break through it, right? And sure enough, they retest it. And so the reason why a retest might work, and again, it's not something that you would solely take a play based on, right? It's not something that you would be like, oh, we're retesting here. That fully warrants an entry, right? You should have multiple confluences for taking an entry. For this, you could probably make up a few, right? We're bouncing off of support. We're making a higher low, whatever it might be. There's got to be multiple reasons for an entry. But on this example, we'll kind of hone in on this general space right here, right? So this is what we're looking at. Like I said, you get a lot of respect at one price point, right? There's a lot of business done there, whether it's just a number of heavy sellers just putting a ceiling in. A lot of business is being done here, and it's getting respected. Okay, so once broken, obviously anyone who's short from this point is now underwater, right? Anyone who's shorted in the last, I don't know, was this 12 hours or so? Anyone who's gotten short, they're likely risking against this level. Okay, so anytime you see a breakout or a continuation move past a key level, it can be summed up to a squeeze, right? What's happening here is not necessarily an excess of buyers, but it's shorts having to liquidate, right? This is a level in which people who were previously shorting are now underwater and are having to liquidate, right? So you get all these people who are short liquidating. So when we see this dip, this is the area that people would look for as like a confirmation, right? Of if it's a real breakout or if it was just a false breakout, right? So the moment that bears are unable to get back under that level, it's like confirmation for them to stop out. Okay. So that's why a retest might get respected or would be acted on, right? So let's say you shorted one of these pivot highs and you're willing to risk a few points higher. Okay. So once this happens, you're probably thinking, okay, I'm underwater, but this is just the first move. I might not be wrong yet. This could be a fake breakout or this could be a liquidity grab or something like that, right? So you get this move over, but once it comes back down here to this spot, let me zoom in for us, right? Once it gets back to that spot and bears can't get it back under, that's what would be their confirmation to get out, that they're wrong, okay? And so then you get the continuation move, right? So if you see a break of a level that was previously respected, you have to think about where people were positioned previously. Okay. So everyone who's short, anyone who shorted, no matter where you shorted in here, this is the level that they're focused on, right? This is the level that they're likely placing their stops at, or they want to see sustained weakness under. Okay. So we break out, you get the initial squeeze, right? A lot of people just using it as a straight hard stop loss, right? We break over, you get a squeeze here, a little bit of stopping out. Anyone who's still holding shorts is looking for this, right? If we can't get back under, that's their cue to get out. Okay. So that's why in some instances, a retest could be a really good entry. But again, it's not something that you would want to base an entire play around. Does that make sense?
Yep, totally.
Awesome. All right. Wow, a lot of people tonight. Love the turnout. Okay, who's got something for us?
UX.
What's going on?
So just building of the last question. So how would you look at the market and determine, okay, these are like the right, I guess, requirements for me to be confident in taking a trade? Like, what are you looking for exactly? Do you have like a checklist of, I'm looking for price to be at strong support or resistance. I'm looking for divergence or, to be bouncing off an EMAs or crossovers or whatever. Like, what's your checklist look like?
Yeah, I mean that's something that we could honestly talk about hours on end. That's a very loaded question just because every play is different, right? There should be a number of things that you pay attention to. I mean, for one, if we just want to oversimplify, I would say you want to make sure you're playing the trend, right? You want to make sure you're not going against the grain, unless of course there's, if we're trending higher and you notice we're coming into a very heavily respected area, that would be one of the only instances in which I would be aggressively, not even aggressively. That would be one of the only instances in which you'd be considering playing inverse trend, right? For example, we've got Mo in here tonight, and if any of you guys follow his channel, you see that he's been reducing his allocation in shorts and has been increasing his allocation in longs, right? And even though the trend is still bearish, right, we've still made lower lows in that time since he started grabbing long exposure. The reason being is there are certain things that indicate, right, we're a little oversold, we're coming into a key area where there's either heavy volume stacking or maybe there's something on time and sales or level 2 that shows, big buyers are starting to pile up. For whatever reason, there's something there that's telling him to inverse trend, right? I wrote up a really detailed explanation in my outlook tonight. If you guys want to check out my channel on why I think we're kind of due for a bounce or a reversal to the upside here pretty quick. And so that would be one instance where you might want to inverse trend. But right off the bat, you want to play with the trend. So if we're long or if the market's trending higher, you want to be trying to buy dips or looking for breakouts, stuff like that. You don't really want to be the guy thinking outside the box in the market. You want to figure out, of course, what the crowd is doing. Again, this is a tough question just because there's there's so many things you can use, right? If you're making money, you're doing something right, and there's no one set way to trade. So I want to avoid oversimplifying, but then again, there's no way we could cover, you know, a one size fits all checklist for verifying an entry. You know what I mean?
Makes complete sense. I completely get it. There's too many indicators, too many perspectives. Like even today, you and Kobe had completely opposite views on, I think it was SPY, but you guys are both right at different times. So I get it.
Yeah.
I guess like an even better question, I guess, would be like, how many confirmations would you say is minimum for you to be looking for?
I mean,
The confirmations themselves.
I mean, bare minimum two. I mean, you could bullshit your way to find two confluences to warrant an entry, but I mean, the more the better, but it does get to a point of overkill. Like, for example, new traders, I hear this a lot. New traders will look for, they'll want to see an RSI crossover, and they'll want to see, they'll want to see RSI is in oversold. They'll want to see so many different things. But if you're looking for 5 or 6 things to tell you to take an entry, you're never going to get told to take an entry, you know? So that's kind of what I mean by every play is different. You're never going to be given the exact same conditions twice, right? So there comes a time when you have to make a judgment call, right? If again, touching on that earlier note of kind of guidelines would be, make sure your risk to reward is positive, right? If you're risking, 20 points to make 10, that's probably not a good trade, right? Even though it might still give you that 10 points and momentum's pointing higher, right? It's not a good risk reward trade. Whereas if you're consistently finding setups to where you're risking 10 points to make 30 or 40, that's a great trade. And at that moment in time, you might not get a lot of confluence, right? There may not be a key support level to play. There may not be, RSI might not be oversold, or you might not, get those otherwise, indicators that would tell you to take an entry, right? So, I mean, it would be an easier question to answer if you gave me like a style that you're really comfortable with and I could maybe touch on it, right? And give you how I would approach it, right?
I got you. I'm still learning, so I'm trying to just get into like swing trading and following. I think it was Wanda and Colby, because you said they're more conservative.
Yeah.
Obviously, like you guys doing intraday is super fast, so I can't really keep up yet. But yeah, I'm doing my best to kind of just see the overall, I guess, movements of the market and figuring out like key pivot points. I'm just trying to understand how that kind of flow works for me.
Yeah, and to touch on that, I mean, Wanda's great. She really scratches an itch that the group needed. I mean, I know you guys watch me and Huji and Cobain trade, and we are very, high risk traders. We play a lot of very short dated contracts, and we are in and out of plays very quickly. But Wanda is there to cater to the people who work during the day or just aren't available and want to take a play that is kind of set it and forget it. She's very conservative. She's got a very solid win rate. So for those of you guys who, you know, if you're here now, I'm seeing a lot of people here now that aren't in the voice chat during the trading day. So for those of you guys who do work during the day or aren't available and want an analyst to follow that is kind of to that niche, Wanda's a great trader, and I would definitely suggest checking her out if you get a chance. It's been a little bit slower recently. Obviously, I wouldn't say she has a bull bias, but she definitely favors calls and relative strength. So it's been a little bit slower on her side as of recent, but regardless, she's still very consistently profitable and plays a very conservative style. So just a quick shout out. Minecraft, I see you've unmuted. You got a question for us, man?
Yeah, with RSI brought up, I just wanted to ask you about like how do you use that indicator if you do, or how would you recommend using this indicator as well?
Yeah, so RSI is, in my opinion, something that is only respected because it's being watched by millions of traders across the world. So that's something you got to understand about indicators like such as Bollinger Bands and stuff like that. And like VWAP, the only reason why these random prices are respected is because there's millions of traders across the world that are looking at those prices and acting on them. Like for example, VWAP. Why does the average price of the day matter? Why does it matter at all for intraday trading? It really shouldn't, but it does because so many traders across the world are looking at that price and acting on it, right? So RSI is something similar where, on high volume days, it's difficult, right? Like if we look at like a 5 minute over the last, let's throw RSI up here, and we'll look at yesterday. Yesterday was a very heavy trending sell day, right? For much of the session. If you're looking at a 5 minute and you're looking at RSI here, I mean, there was one time it really gave you a good oversold signal, but if you were buying it the first time, I mean, it told you it was oversold here in the pre-market. It told you it was oversold here. And sure, each of them got minor bounces, but that's, if we want to look at like what the actual risk to reward was of a play like that, I mean, here's the first one in pre-market, right? What are you risking? You know, your risk is, say, I don't know, let's say you're longing the first time it flashes oversold. You're risking, let's say your stop loss would be that last pivot low, right? From 75, right? From 90 to 75, you're risking 15 points to make, I don't know, what would your target be if you took this play, what would your target be? 25, 40, right? I mean, you're going counter trend on a read that is coming from a low volume period anyways. Okay. So it flashed oversold numerous times, right? Here it flashed oversold, and yeah, you might have gotten a little tiny bounce here, but we still ended up breaking lower. And here it flashed oversold again. This one got a good reaction, but on above average volume days, RSI is going to lead you astray a lot. And even VWAP. I mean, for the longest time on VWAP, I use the 2 standard deviations, right? If you look at the action on VWAP today and yesterday, we were, it'll get a slight reaction, but we end up breaking lower than that price anyways after a little bit of rebalancing, right? So those indicators, they're really only respected for short periods of time because, like I said, millions of people across the world who are trading it are watching that level and are acting on it, right? It doesn't necessarily mean anything, right? What is too low can go lower. Because RSI tells me it's oversold doesn't mean we can't continue to go lower, right? And again, it has to do with the time frame, right? Like yesterday, RSI told you it was oversold 3 times. We made lower lows every single time after it told you it was oversold, you know? I mean, really, if you're using RSI, you're looking for very small moves if you're using it on a 5 minute. If you're going to use RSI, I would use it on something that a lot of people are really making decisions off of, like a daily time frame. A daily time frame is something where RSI is likely to get a lot more valid respect, right? Look at the times that it's flashed oversold previously. That's the day of the low. That's the day the low was made. And then check this out, right? Flashed oversold. That's the day the low was made. And most recently, check us out now, right? It's been flashing oversold for a couple days here, but I wouldn't be surprised if this ends up being an intermediate or short-term low, right? Again, I mentioned RSI verbatim in my outlook tonight, right? And this is why, because on the daily, it gets a lot more respected. If you're day trading and you're looking for, short time frame moves, in periods of high volatility and massive volume, it's not something that I would rely heavily on at all. But on that same token, it's something that if there's multiple other things that are happening while our RSI is flashing oversold, then you can act on it and use it as one of your confluences, right? But would I base a sold trade on it? Absolutely not. Make sense? All right, cool. Wow, a lot of people tonight. Maybe we'll start hosting our sessions on Tuesday. All right.
Yeah, I appreciate that. I didn't realize I was muted.
No, you
Make
can,
a look at it.
right?
Like when it comes to indicators, I know you use VWAP a lot. I'm not sure if you still do, but you just use levels in a sense of charting, or how do you like to do things nowadays?
Yeah, me personally, I'm about as technical as it gets, man. I believe in price action and volume profile and common sense, right? Play the trend, give respect to levels that are getting respect. And I mean, at the end of the day, price action doesn't lie. Price action shows you decision making. Price action shows you real time decision making. And again, I'm going to discuss a topic right now that we do not nearly have enough time to cover, but in voice chat, if you approach me with this for the next couple days, I'll be happy to go more in depth. But
I got you.
to over summarize, if you can find out where people are positioning and how they have to react based on a given move, you are much more likely to catch moves such as breakouts or breakdowns, or whether we're getting stuck in a range or what. Like I said, here's a great example, right? Looking at just today's action and why. I mean, for those of you guys who were in voice chat today, I know we didn't send the alert, but we caught this move. We caught this breakout and squeeze today for like 80 points just off of this fundamental understanding. Okay, so let's look at the last 2 days, right? Yesterday night, we made a big impulsive low at 60 here. Okay, very respected level, hard reversal, right? A lot of volume, flashed oversold, all the fun stuff, right? We knew 60 coming into this morning was a big spot. So this morning, we did try shorts looking for the break under 60. We took a loss on this first entry, right? This was a bounce. A lot of volume done again. They built a floor there, okay? So that further confirms that 60 level is big, okay? We see a little bounce, and it's a failed reversal attempt, right? We see a lower high. Bears are still very much in control. We fall back into 60. And guess what? This is where our confidence comes in for shorts, okay? We see a lower high here. We're pretty confident we're getting this break under 60. We caught the short. We made some money. I heard some of you guys say you caught that with us. Great. But the real play came here, okay? We break under 60. Everyone who's long overnight or this morning, anyone who gets long is watching that 60 level, okay? Once we break 60, that's their opportunity to stop out. That's them telling you, okay, we're wrong. We got to get out. That's why we got the continued flush lower, right? Was longs covering their position. The fun part is when we get back to 60. And I know some of you guys, we just talked about retests, okay? So when we get back into 60, this is people who missed out on their opportunity to get short, okay? When we break 60, this is the exact opposite of what we just talked about in the other example, okay? When we break 60, anyone who's long in this period or anyone who's long previously, this is their level to liquidate. They know they're wrong, okay? So when we break under that, where does confidence go? Confidence goes to downside. People start chasing shorts, okay? VIX is high. I think at this time of the day, VIX was nearing 19, or not 19, 29, and was looking to break higher, okay? So contracts are extremely expensive, and people are chasing into shorts, okay? So when we re-break back over 60, what happens to all those people who not only closed their calls, right? So people are offsides if they were in calls and chase shorts. You got all these people piling into shorts with the breakdown. What happens to all those people when we reclaim 60? Those same people who were overpaying for contracts and were chasing low of day are underwater deeply here. And it just naturally occurs with a squeeze, right? All those people who chase shorts are put on pressure, and that's their level to liquidate, right? So this is what I mean. When you understand where people are positioned and how they have to react based on a given move, that's when you're going to catch breakouts. And we can simplify here by just saying this is a failed breakdown. Anytime you get a failed breakdown or breakout, typically the reaction in the opposite direction is very good, right? It's a great play. And so again, for those of you guys that were in voice chat with us during the second half of the day, we caught this move, right? We longed the moment we claimed 60 and we're fighting with it. We knew, okay, everyone just closed their longs and chased shorts, and now they're about to get flipped on their head. They're going to have to liquidate, which is going to drive a squeeze here. Okay, so again, we didn't time the low, we didn't snipe the low or anything. There was no reason to, right? There was nothing down there telling you this is the spot, right? At least based off of what I look at. There was nothing down there at the pivot telling me this is where you want to long. It was this action here, the reclaim of 60, that validated further upside. Does that make sense, guys? Again, we're way oversimplifying here because we could talk about this type of action and understanding where people are positioned and how they have to react based on a given move all day, right? But is this making sense, guys?
Yeah. Wax, I got a quick question. Is that, it's sort of like the whips to sides right there that you're pointing to, sort of indicating that we're fighting 60, that we're going to get a squeeze? Like, why couldn't you just seen that as like a, just like as a retest of 60 before the further drop? Is that there that you're pointing to that sort of indicates that the squeeze is coming?
or like what?
I mean, that's tricky. It really happens on a minute by minute basis, but I would argue you knew a squeeze was coming the moment this rejection got aggressively bid back. The moment
Okay.
that we
Okay.
failed, the moment that we failed to see lows again was when shorts realized, oh shit, I'm in trouble. Okay? Because this was a
Okay.
bounce. If you're chasing the lows, you're likely gonna sit through a bounce, right? You overpaid for contracts, but you know to a certain degree, so long as we're under 60, bears are still in control, right? It's when we reclaim
Right.
60 that they think, oh shit, we've re-entered the balance. Now we've got room higher. I need to get out, right? So how do I want to say that?
Because a more confident entry have been on that green candle rather than that red candle wick.
This one.
Because couldn't we have still couldn't we have still just like just continued down, right? Because like at that point you're still kind of fighting 60, so isn't that sort of like the retest in a sense? Like how do you know for a fact that right on that candle that's like this? Are you basing it like off of just the fact that that red candle only filled like halfway and that we got that long wick to the downside, or what?
It's hard to describe because we were watching the action real time. Whereas right now, obviously hindsight's 2020, but I guess you're right. Yeah, this candle probably would have been the more confident entry, but at that point, look at how fast this candle went. It went from 56 to 86. That was a 30-point candle. You probably wouldn't be very confident chasing calls at that point, right? Even though it played out, I mean, it's you gotta take the entry at the level where you're confident again. But again, it's tricky to say on a minute basis what is the better entry. But you have to know that while you're thinking about the entry, everyone who chased shorts is thinking about it themselves. They're thinking, oh shit, do I need to liquidate here? Do I need to, do I double down or what? Right?
Yeah, you don't know for a fact. You don't know for a fact. You just know that there's good risk to reward to get long there.
Yeah, I was gonna say
Right. Huji has really put me on to this idea as well, and now, after some time, failed breakdowns and failed breakouts are some of my setups. So if you guys have questions, you can always reach out to me or Huji. Okay, so I was actually Huji right before you chimed in. I was just about to throw this to you and see if you had any input on this. You still here?
Yeah. Like I said, you're never gonna know for a fact. I mean, you know what I mean? Like but you got good risk to reward there, and you know where you're gonna stop out. If you cannot hold that 60 on the next candle, then you're gonna get out. The next candle took off, so that's why the risk to reward's good there.
I mean, if you're a really risky trader, how I would approach this is just say, the thing is, once we bounce after the continuation move, everyone's eyes are on that 60 level. Okay. So at this point, I would argue that you could either play the confidence with the strength over 60, like that candle you were talking about, or you could just be aggressive and say, so long as we don't make a new low of day, bears are losing control, right? You could, if you wanted to enter at 60, again, I don't know, like if you wanted to do risk to reward on this, let's say you entered at 60 and you'd be risking down to low of day, you'd be risking 25 points up to that last pivot, so you'd be risking 25 to make, what is that, from 60 to 10. So you'd be risking 25 to make 50, right? It's a nice 2-to-1 opportunity. But yeah, you could have approached this either way, either waiting for the strength over 60 or being rather aggressive and saying, okay, I'm risking down to low of day. Because so long as they don't make a low of day, there's still a good chance that squeeze can come, so long as they eventually reclaim 60.
Interesting. And is low of day where your stop is? No.
When I took this position, yes.
I'm sorry?
When I took this position, yes, I was willing to risk down to low of day.
Really? Okay.
Yeah,
Okay.
but I didn't enter at 60. I entered on this candle. I didn't enter good. I entered at like 56, and I had to sit through this 10-point drop with a sock in my mouth, and I was mad. Is Espresso Martini in the chat? He took the trade with me, and we were having a good old time. But when we sat through this candle, we were both sitting there like, ouch, that hurt.
Yeah, I mean, if you're trading XTX, you have to be willing to risk that, really, or else you're going to get stopped out so often, not touch the move. Like that's one thing you got to want to risk a little bit more than what you really are comfortable with to win on SPX.
Yeah.
Right. So I guess just size down, right? Because I mean, especially if like VIX is high, then yeah.
Yo, Wax, when you get a minute, could you pull up Tesla this morning and do the risk and reward on making a little break? I just want to kind of look more into that trade I took.
I mean, the only unfortunate part is, I mean, there's not like an established range here. So it's pretty, I mean, you could argue, I mean, we respected this 220 area a good bit. You could use that for a basis. Where did you enter and what were you looking for?
Let me just check. I think Cobain is I took the Cobain. You were looking at break and retest at 232 with the 230 weeklies, but he opted for the TSL 08 calls.
Okay. So my best guess is he was just looking for strength over the pre-market high. Does that sound about right?
Yeah, I mean, we had that strength. It's just that shit faded so quickly. I kind of wanted a better idea of what was going on there. A better understanding for next time.
So the reason why, again, you guys have probably seen over the last week or so, I have not been making planned plays, right? And the reason for that is because indexes drive all action when volatility is this high. Okay. It doesn't seem worth it to me to find setups on individual stocks when if the market drops 2% tomorrow, it doesn't matter how good the setup is, it's likely going to really struggle, right? So we call these overwhelming market waves, right? If the market's moving 1.5 to 2% every day, like yesterday, right? Yesterday was a really deep red day. I would have paid you to be able to find a green stock for me, right? And I'm not talking about some random blue collar tractor company that's outperforming off of good news, right? There's going to be anomalies every now and then, but realistically, most of the market is having a red day when the market is down 2%. Okay. So it doesn't matter how good the setup is. You want to play what the market's doing. Now, when VIX is low, right? When VIX is low under 20 and ES is only moving 0.3 or 0.4% a day, it's much easier for individual stocks to move more independently, right? You can still find outsized moves among individual stocks, right? You can play news, you can play setups and stuff like that, and not really worry much about indexes. But for example, like today, Tesla right off the open got a big push, broke through its opening high. But I'm sure if we do this real quick, the timing is going to line up really nicely. Okay, so we're going to set up two charts here, right? Let's look at ES and let's look at Tesla. All right, so here's Tesla this morning. Let's throw that on 5 minutes to keep things equal. Here's the morning action. Okay, so the bell rang, right? ES got a nice little push up right off the open here. So did Tesla, right? Tesla got a nice little push up off the open. All things considered, it looks great. ES hadn't cleared its pre-market high, right? But Tesla did. Tesla looked great. They were showing relative strength this morning. But lo and behold, ES gets hit with a massive pivot. And I'm not talking like this is not some tiny little thing. It looks like it's just a little tiny drop here because we've gotten used to these massive outsized moves, but that's a 50-point sell-off. That's damn near a full 1% sell on ES. No stock is just going to be able to thrive right through that. No large cap, at least. Okay. So sure enough, when ES pulls, Tesla got pulled at the exact same time. Let's look at that time the sell really started here. Right. So your sell started about 710. What was ES doing at 710? Right. Here's your 710 candle. Big old continuation move. Okay. So to me, it just doesn't seem worth the effort to focus on individual stocks when volatility is as high as it is right now. You get what I'm saying?
Yeah, I'm tracking. So another question I have when it comes to those indexes is like contract, like where do we want to be putting our strike prices on the cons, or like far out of the money, how far into the money on the movement of those cons? In a market like this, do we really how do we make the most of utility?
Oh, that's a tricky question. ideally you want to be as close to the money as you can. That's just where that's the best risk to reward trade-off is, right? But I know a lot of us can't afford, SPX contracts with VIX up here damn near 30. SPX contracts are almost $3,000 at the money at the beginning of the day, right? So it's just not really a question of like plausibility. So you're gonna have to make a judgment call. Realistically, if you catch a 50-point move on ES, no matter what contracts you're in, you're gonna make money, right? Unless it's the last 10 minutes of the day and you're 100 points out of the money. But chances are, if you're catching a decent move, if you're catching 50, 60 points on ES in either direction, any contract is gonna make money. But you want to be close enough to the money to where the gains are actually meaningful, right? So that's up to you. I would honestly just advise, like, I'm alerting contracts that are $900, right? And we're still 50 points out of the money. So for you guys following, I would definitely advise you want to be as close to the money as possible. So without paying $3,000 a contract, the safest way to do that is just to substitute my plays with SPY, right? SPY contracts, you can get much closer to the money, play much safer for a lot cheaper, right? The only difference is the intrinsic value. If SPX goes $10, it's $1 on SPY. So if our contracts do go in the money, that's where things are going to vary. But a lot of people don't believe me when I say this, but on same day contracts, SPY and SPX yield the same returns, damn near identical returns. So I want to show you guys this because a lot of people don't believe me when I say that. But let's look at this bounce here, right? From low a day to the high a day, right? We got the exact same charts up. We got ES and we got SPY, okay? If you're playing, let's say you have a $10,000 account, right? And your max risk is 10%, right? You can only use $1,000 per trade. If I alert a contract that's 800 or $500, realistically, you can only afford one contract within your risk. That's not a good idea because it doesn't give you any scalability. It doesn't give you any control over the position. Okay. So what you can do instead is you can play SPY contracts, right? They're much cheaper and they still have the same odds of going in the money. So what I want to do here is I've got, 1 and 2. We're going to look at SPX and SPY contracts both at the money today. Okay. So I did this example with someone a little earlier, right? So we're going to link this, unlink. Here's SPX, right? And the at the money contracts we used are these guys. We're going to send that info to our first chart. Just double check it went there. Great. And then back to the trade tab. We're going to do SPY. And we're going to do the same contracts, right? Oh, delete that. We're going to send this to our second chart. Now check this out. This is where it's really fun. Okay. So we've got the exact same move. And you can see on the contracts, right? This is SPY versus SPX. They're the same, right? So let's say you're an absolute sniper and you just knew we were going to rally from low a day. Okay. So you probably paid about $550 for these contracts. So from $550 to high a day, look at that percentage. About 1,100%, right? Can you see this little box right here that's populating? It's about 1,100%, right? Great trade. We'll leave that there. Let's say you did the same thing with SPY contracts. Those contracts you would have paid $550 for. These contracts were only 60 cents. Let's say you paid 60 cents. Oh, I got to fix my drawing. Let's say you paid 60 cents for them, okay? And you caught the move to high a day. Look at that percentage. Pretty much 1,100%, right? It's the exact same trade. It's just to get exposure to the position, it requires much less capital. Okay. So if I sent this trade this morning for $550, if you have a $5,000 account, you can't even afford one contract within that 10% risk, right? So let's say you do take one contract playing outside of your risk, right? You only have one contract. You have no control over the position. You probably trimmed right here at, I hope you did. That's still 300%, but you probably trimmed right here and you're watching it the rest of the day like, oh my God. Whereas here, you can, if you're using that same risk, $500, 10% of your account, at $6 a piece, you can afford like 9 of those contracts, right? You're using the exact same size that you would have otherwise used on SPX But now, because you have multiple contracts, you have control over the position. You can take trims. Once you take a trim, you can set a trailing stop, right? Like, if you guys want to substitute my plays on SPX for SPY, I recommend it, right? They yield damn near the exact same returns. And people don't realize that. They just think because the contracts are cheaper, they're not going to make as much. Yeah, if you're buying one contract of each, obviously you're going to make more money with SPX, but it also requires greater risk up front. Okay. So again, if you guys want to substitute my SPX plays with SPY, it's totally fine. I recommend it, right? You can get exposure to the same play. Again, don't confuse this. You're still taking on the same risk. This goes both ways. If my contracts lose 30%, the SPY contracts will likely still lose 30%. I'm just saying, if you are limited in capital and you can't afford multiple contracts of SPX within risk, the best way to do that is just to substitute with SPY, right? They will yield very similar returns, like almost identical, right? This move yielded both 1100% on both moves, whether you played SPY or SPX. Make sense, guys?
Yeah, can I jump in actually while you're on this topic? So is 10% risking 10% on a trade pretty standard?
I would only recommend 10%. 10% is still pretty aggressive, if we're being honest. I would only recommend 10% to people who are working on growing like smaller accounts. Like if you're working with less than $50,000, 10% is pretty standard. But once you start working with a large account, like say 100,000 or $75,000, there's really no reason to be still risking 10%. You can still make very good returns and still catch very large moves with high dollar payouts using only say 5 or 4% of your account with that kind of capital. But yeah, if you're working with say 10K or less, you pretty much have to use 10% because that's the only way you can get multiple contracts of anything really.
Right. Okay. And then also, I guess to build off of that, like I said, I'm new to options. So when you say you're risking the 10% per trade, are you actually waiting until expiration and like if you're out of the money, you're out maybe 10?
No, absolutely not. Definitely not. I will never let a contract expire worthless. I know I'm wrong long before the contracts are worth zero. And again, just to touch on this, I know a lot of people do this. They'll see their contracts down 70% and think, oh, I'll just let it expire worthless. I've never understood that. You know you're wrong. It's likely not coming back. Just preserve the capital, right? But anyways, what was I going to say? No, there's two ways to assess risk. I do it like that just because it's safer. You assume the risk of the entire position anytime you take a trade. But in reality, no, you're not. If you want to use more than 10% of your account, you should adjust. Your stop loss should be your risk, right? So let's say you take a trade and you're only willing to lose, say, 2% of your account a day. The trade may cost you 10% of your account, but that means your max loss on the position can only be 20%, right? Because that would be 2% of your account. Does that make sense? Yeah, there's two ways to assess risk on your trades. Me personally, I like to assume the entire position as the risk, and that's just safer, right? But yeah, if you have a max drawdown of say 2% and you're using 10% of your capital, that's going to affect what your stop loss has to be, right? And so your risk on the trade would be whatever your stop loss is and not the entire trade.
Right. And okay, perfect. Might be a stupid question. When you're executing your trades, you're doing market orders, obviously. Like usually, for the most part, I think you got not limit orders.
Yeah, I mean that's going to be preference. I mean, me personally, for entries, a lot of the time I'll do limit orders. And then if I don't get filled on my full amount, say my entry is just so good that only 5 out of my 10 contracts fill, then I'll market fill the remaining contracts that I want. But for sells, because SPX contracts move so violently, and you'll get moves like this, right, where at a given price you only may have those prices for moments. That's when you want to do market sells, right? Like when you have to sit there and spend 10 seconds inputting your order and setting the limit price, you might have missed the opportunity. So when I sell contracts, I have like a general area. I mean, a lot of the time, if it's trending in our direction, I'll just set limit orders, and when they get hit, send the alert. But when you're trading very, very quickly, say with futures or on SPX contracts near the end of the day, it's likely best to just where you want to take your trim, just send a quick market order.
And the last one, I know I'm taking up all the time here. Sorry, guys. How do you set a stop loss like for options? Because like I noticed that when I go to place my orders, they ask me like the order type and like the whether it's like market execution or buy limit or sell limit. But I don't really see anywhere to put a stop loss.
So it depends on the brokerage you're on. I know for Tasty Trade, when you click order type, there's 4 options. There's limit, market, stop market, and stop limit. You've probably noticed that if you click sell in limit price for a price that is lower than the current price, it'll automatically just sell the contract. So you have to set a stop order, a stop limit, or stop market, and that basically tells the brokerage, I'm not going to sell this unless the price hits this. I don't want to sell right now because if you just place a sell limit order, like I said, if your contracts are worth 600 and you want a trail stop at 500, if you send a limit order at 500, it'll just immediately fill you right now because they're thinking, oh, he's willing to sell at 5. They're at 6 now. We're going to fill that order, right? But a stop market and a stop limit says, hey, I don't want to sell unless price hits this price. Okay. So again, I don't know what
stop.
Yeah, you need a stop order. I don't know what brokerage you're on, so I can't really help you much further than that. But I know on Tasty Trade, it's real simple that you hit order and there's just 4 order types.
Yeah, for me it's only 2. I'm just using Webull for trading, just getting the hang of things.
Gotcha.
But I'm sure I can find it on Google. I just look some videos. Thank you though.
Yeah. All right.
Actually, can you cover the SPY?
Yeah, I mean, I'm not gonna do that tonight just because I wrote a really detailed kind of outlook in my market outlook tonight. I want to give some other people a chance to get a question here. That goes for everyone. If you're interested in what I think the market's doing tomorrow, just head on over to my channel, and I wrote a big outlook tonight. I think I explained it pretty thoroughly. Sorry, JC, don't mean to cut you off. Just we're limited on time. This session has flown by, and I want to make sure other people get a chance to get some questions out.
Just so you all know, supplements do not work on Robin.
Good to know.
Work up hard one.
All right, let's hear from someone we haven't heard from before. Green Day, fitness, Hora, artist. Any of you guys got anything you wanna ask about?
No, I'm just trying to get more used to you, or trying to understand you a little better, because I noticed you were new on Formula Office.
Oh yeah, they just hired me. Nice to meet you, man. Oh, did you have a question?
Yeah, I did. Okay, so I still don't understand how. Okay, so obviously, the S&P sort of tracks the top 5, right? So obviously, if the S&P is green, then I guess the majority of the stocks are green that day. But I don't understand how like SPY and SPX options affect the price of the S&P, and how individual stocks also affect the S&P. Like does the S&P take into account options and the individual stocks as well? Like I don't understand how. Yeah, I mean that's pretty much my question, is like how do like SPY options affect the price of SPY along with like Tesla and Apple and all of these other companies?
Well, I mean, it's a managed fund. So I mean, it's basically just holdings, right? The bigger names that are the holdings. I mean, if I had to guess off the top of my head, obviously, Apple and Microsoft, I believe, are the largest holdings right now. I mean, Nvidia might have climbed up there recently just from pure growth. I know it started out as a smaller allocation, but it has likely grown to be a large allocation of the fund now. But when those names move or grow, it's just based on how large of an allocation they are. Like, for example, what are some smaller names in the S&P? like United Healthcare, right? United Healthcare is still a massive company, but they don't hold nearly the weight in the S&P 500 as, say, Microsoft or Apple, right? So if you're looking at UNH, when we had that awful news of right their CEO being assassinated a couple months back, they tanked, right? But we didn't see much reaction on the S&P 500, right? It's likely because that same day other names were still just as strong, other names that had a greater weight in the fund, right? So it's just allocation. That's all. That's all it really is that's why individual names are. People like to joke and say, "Oh, the weight of the market is on Nvidia's earnings report," right? Because it holds such a massive allocation at this point now that, and you got to think one name affects a lot of names, right? If Nvidia reports poorly, you see names such as AMD, SMCI, ARM, Intel, ASML. All those chip companies get hit as well, right? And so a number of those companies also hold weight in the index too. So it's just dependent on allocation, right? And how much weight that given stock has in the index.
So does options trading and shares trading on the S&P have any effect on the S&P price, or is it just like individual stocks? Like,
it absolutely affects individual stocks. Yeah, it absolutely affects individual stocks. Now, whether it's directly correlated to the S&P 500, I'm going to be honest with you, I'm not entirely sure. In regards to the ETF SPY, surely it definitely does. I mean, you just thinking about like executions, right? When contracts are executed, that's 100 shares per however many contracts are changed hands, right? And that's about as much as I can give you, other than just recognizing the weight of each allocation and the execution of contracts. That's about as much as it'll go. As for the direct effect on indexes.
Right. No, but sorry, I mean like the options contracts in the individual stocks. I meant options contracts on like SPY.
Yeah, that's what I was just mentioning.
So right. Okay, I see. So options contracts on SPY and the individual companies' prices both sort of get blended into portray the price that you see on the S&P.
Hang on. I don't want you to start over, but say it again.
So options trading on SPY and individual companies is like I guess like price movement blend in to portray the price that is shown on SPY, right? Because it sort of takes into account both. Like I guess that's the part that like I'm like lost on is like if because you were obviously saying that options like placing a call option is the same thing as buying 100 shares. So if I'm buying 100 shares of SPY, right, and someone else is like just guess like buying puts on like Tesla or something, how do those two sort of combine to give me the price on SPY that I'm looking at?
I mean, the price of the price of I mean, SPY follows the SPX, right? SPY is a following ETF, right? It's a managed ETF. I mean, you could make the same argument for both VU and IVV and those, but SPX is moving based on the allocation, right? And when contracts are executed or there's positioning, that has a direct reflect on that company's valuation. So that's how that's transferred over. I mean, if you're looking at just SPY or SPX, options 100% play a key role in the movement. You've heard of the term like a call wall or a put wall before, and how those are kind of the bigger pools of liquidity that price is out searching.
Yeah.
That's the best way that's the best way I can connect this is if you're familiar with call walls and put walls, that's how options are playing into the pricing of the indexes.
Interesting. Okay. Thank you.
Yeah. All right, folks. We got about 5-10 more minutes here. Anyone want to wrap us up with a solid question or anything like that?
Yeah, I have a question if you don't mind.
Sure.
Nice to meet you, by the way. I'm from Only Options Trade as well. It's a nice technology to follow up. I was curious. I haven't seen many people do with the 0 how you use VIC in Confluence with that.
Oh, that's a great question. This is something that, again, we could talk hours about. Okay, so I want to use the example that we were just talking about with that squeeze that we saw on the reclaim of 60 earlier today. We'll use that because that's a good example. So one thing to just kind of note is that panic sells lead to FOMO, right? People are chasing contracts. And so VIX, if you're not familiar, its value is derived from the speculative value on short-dated SPX contracts, right? So you're familiar with intrinsic versus speculative value, right?
Yes. Maybe you
Okay. So basically,
Oh.
VIX is a measure of the speculative value, right? When people are chasing contracts, let's say over the last few days, you're holding shorts, right? You know what you have, you know they're worth a lot. So people are fumbling to buy those contracts off of you. And if they're in a rush to buy those contracts off you, you're not just going to sell them for whatever price, you're likely holding out, right? And so there's a supply and demand.
Go lift.
There's a supply and demand issue, right? The supply of people holding shorts is not great enough to meet the demand for those shorts, right? So people are fumbling over each other, willing to pay whatever for those contracts. And that's how VIX gets driven up, right? The speculative value on contracts increases because people have large expectations of bigger price movements, right? So that is how the VIX's value is derived. But, when you're seeing moves that are outsized on the VIX, that likely tells you people are paying an arm and a leg for contracts. They're overpaying, right? And so let's look at yesterday's bounce, that end of day squeeze, right? So that end of day squeeze, okay? So here you've got end of day, VIX launches through 28, right? In a matter of 15 minutes, we've moved at $1.50, right? And the selling has sped up, right? So people are chasing shorts. They're willing to pay whatever, okay? And so naturally, you get a whole lot of people just outsizing themselves to buy contracts. And so naturally, the very first green candle, no matter how big the size, the very first green candle tells those people, oh shit, I chased, and now there's no longer that FOMO, right? People are no longer fumbling over each other to pay whatever price that they can get it for. So that puts pressure on those late shorts. So I'm just using the first example I can think of right now on how we would use VIX. There are lots of different ways to use it. As I said, we could talk about this all day. But in this most recent example, VIX got way ahead of itself. And that's telling you people are overpaying for contracts. They are fumbling over each other to get their hands on some shorts, right? So it doesn't matter when or how big, but the very first green candle, that demand drops, right? All of a sudden, the supply is in excess and the demand is falling. So if you're familiar with economics, anytime you've got an excess of supply and demand is low, they have to balance out. So what happens? Price has to come down, okay? So in this regard, we're talking about the shorts, okay? So the moment those shorts start to correct and the price comes down, that's when the pressure is put on those shorts and you get a massive correction of people liquidating those shorts, right? Everyone that was chasing on the way down, this one candle puts them all underwater. I guarantee you, it doesn't matter if you entered here. If you entered right here, I guarantee you this one candle made you red on your contracts, right? Just because of how fast VIX fell, right? That's a direct reflection of the contract values. Okay, so you can use VIX to time out when people are overpaying, when there's an imbalance between supply and demand, all sorts of things. Again, VIX to me is, as of recent, with it just trending higher, it's kind of just been like, okay, there's a lot of fear, continue to stay short, right? But there do come every so often golden opportunities like this, right? And if I had to summarize, I would just say panic sells lead to short squeezes, right? Because you get that FOMO of people just willing to pay anything to get some short exposure. And then those same people, we call them the late shorts, are squeezed out, right? So that's exactly why we got that big old bounce yesterday into the close, despite the whole day being a nasty, ugly trending sell day. Okay. But again, if you'd like, I think it's worth the time. Next week, we could spend a whole session talking about VIX. I would not mind.
Yeah, I love that. That's something I definitely lack knowledge on, so that'd be great.
Yeah, VIX is a very useful tool, and I personally don't think I could trade the way I do without it. It's odd because you're performing a level of technicals on VIX, but not traditional technicals, right? It's I don't want to say it's an acquired taste, but it definitely takes a bit of, you know, you got to watch it for a few months and through different market conditions to really get a feel for how you can use VIX for your trades. But
Well, I appreciate it. Thank you for all that.
yeah. I'm gonna wrap the session up here, guys. For those of you new people, all of these sessions are recorded and are posted on our YouTube page. So if you like what you're hearing or you like what you're learning, you can head on over to our YouTube page and watch any of our previous videos and always refer back to me to questions if you have any. Again, great turnout tonight. I'm happy most of you guys were able to make it. And on that note, I hope you guys have a great rest of your night and let's have a great rest of the week, okay?
All right. Yeah.
Wax.
Yeah, what's up?
Nice to meet you.
Yeah, you too.
I was just wondering, I'm completely new to kind of all this stuff, and like on your, you happen to like know just like, or a beginner would kind of